Welcome to another episode of Einstein Retirement Daily, where we cover topics and news items and things of interest to those of you who are gearing up for or already in retirement. On today's episode, we're going to talk about a common retirement question, which is, should I withhold taxes from my Social Security benefits? More on this to come right up. As always, if you hear something in today's podcast that causes you to want to make changes or take action in your specific situation, we do insist that you confer with the appropriate tax, legal, or investment professional prior to making any changes, and someone preferably who knows your specific situation. Okay, very common retirement question. Should I withhold taxes from my Social Security benefits? So, if you're not already aware, most people do pay taxes on their Social Security benefits. When the law was changed so that taxes first came to Social Security benefits, first time around was 1983. President Reagan, in an effort to help out the Social Security system, enacted signed a law that would cause Social Security benefits to become taxable for higher wage earners. That law was then enhanced and increased. The tax exposure for Social Security benefits was increased. In 1993, President Clinton, I always like to remind people that it doesn't matter which side of the aisle you sit on. We can all be angry together, okay? So, yes, taxes added by Republican president and increased by a Democrat president. So there again, don't get too political on me. All right. So the question is, should I withhold taxes though? Well, most people do pay tax on their Social Security benefits. When the laws were first put into place, a minority of folks paid taxes on their Social Security benefits. And that was because of this wonderful provisional income number that if you're single, it had to be over $25,000 of income in 1983 was a pretty good amount of dollars to have coming in retirement. Today, obviously, that's very easy to hit. And then 32,000 for a married couple. And then you can hit a full 85% of your benefits becoming taxable. And for some reason, I can't call those numbers directly to mind. I want to say 34,000 for a single person, 44,000 for a married couple could have you subject to paying tax on up to 85% of your benefits. So if your benefits are going to become taxable, the question obviously is, should I do tax withholding from my Social Security benefit checks? Now, the first thing I want to highlight is that you can do tax withholding. Okay, so that is something that is available to you. You can tell the Social Security to send dollars directly to the IRS for you, and that is an option that you have. But you do not have to. You can withhold zero on your Social Security, meaning you have no taxes being withheld on your Social Security benefits, even if those dollars are taxable. So if you don't withhold taxes on your Social Security benefits and those dollars are in fact taxable, then what you want to do is you want to make sure that your withholding from other retirement income sources is coming out in enough to cover those tax requirements. So for those of you who have pension benefits, obviously you're going to want to do extra withholding over and above just what's required for the pension to make up the difference. Okay, so that would be one way to deal with this, would be to do extra withholding, say from pension benefit dollars. Another way to handle this is that you could have additional withholding from withdrawals from 401k accounts or IRA accounts. Typically speaking, when you're taking income from 401k or IRA types of accounts, you're going to do some kind of tax withholding that would be very similar to what you were used to doing or having have happen when you were working. So when you're employed, your employer is going to withhold taxes for you and send those dollars directly to the IRS. When you're retired, you generally want to do something very similar, but you're going to just have your taxes withheld from 401k or IRA withdrawals. The benefit of doing it that way is that if you need to make changes to your tax withholding, typically it's going to be very simple to work with a financial planner who's helping you manage your accounts, or your broker or your brokerage institution, your custodian, to change or increase your tax withholding out of a brokerage account, or decrease that if that's applicable to you. So generally it's much more easy, simple, flexible to increase or decrease your tax withholdings from places like a 401k or an IRA and that sort of thing. Generally, it's more cumbersome, more complicated to make changes with a pension. And think about how cumbersome that is. Double the amount of difficulty and cumbersomeness and complicatedness of adjusting a tax withholding on Social Security benefits. Just a lot of extra paperwork, a lot of extra steps. So generally, if you're going to be taking income from other sources, okay, when I work with my clients and we're doing our tax planning and tax withholding on for the year, we're typically planning that those tax withholdings are going to come entirely from 401k and IRA types of accounts. And the reason for that is really, in a lot of ways, convenience and ease and flexibility. Okay, you'll have the ability to modify and adjust that. Now, the reason why you'll want to typically go down that path of doing the withholding directly from those accounts, rather than doing, say, a quarterly tax payment, is that a quarterly tax payment is a big pain in the butt. Okay, just to put it simply, it's no fun to have to deal with that. And especially if you're going to do any advanced tax planning where you're maybe realizing some long-term capital gains, or you're going to do some Roth conversions, any of that kind of tax planning, you do want to be mindful of that. You want to make sure that the taxes are going to be withheld from your 401k and IRA accounts if that's applicable to you. The only exception to this, obviously, is going to be your Roth conversion. And that Roth conversion, typically we recommend that folks wait till the fourth quarter of the year to do that. And then that just makes it so that your tax payment is going to be due on January 15th of the following year. So Roth conversions, you typically want to wait till the fourth quarter for several reasons. One is you want to get all the unknowns out of the way, make sure there's no surprises. Undoing a Roth conversion is possible, but it's a pain in the butt. So you just want to wait, okay? Wait to do your Roth conversions, typically till the fourth quarter. And then that way you can just handle your tax payment by January 15th, and it should be no problem. Now, the other side of it is that, again, we still have to factor in the fact that there will be tax exposure on Social Security. For ease, for the purposes of ease, I would say you want to have your taxes withheld from other sources. Again, 401k or IRA types of accounts, typically being the most convenient method for doing that. Okay, I hope you found today's episode to be helpful to you. The question about whether you should or shouldn't depends on whether or not that tax exposure is there. And are you taking income from other sources that are maybe more simple to do tax withholding? And that would be my general advice, is try and do your withholding somewhere else, not on the Social Security benefits themselves. But you obviously can. Okay, it is allowed, and Social Security can set that up for you. With that, we will wrap up for today, and look forward to seeing you next time.